Hello, I'm William Clark from Mining Journal, and I'm here with Bruce Griffin, the Executive Chair of Sheffield Resources, to talk about the Thunderbird project in Western Australia. Bruce, good afternoon.
Hi, Will.
Firstly, congratulations are in order, I think, as Sheffield has now completed financing on Thunderbird. Could you tell us about where the project stands now and your path to production?
As you said, we're fully funded. We made our final investment decision on Friday of last week, or actually on Thursday, and announced it on Friday. Now that means we continue with construction, so we're 40% complete on construction already. We've been spending equity that our Chinese partner invested with us a little over a year ago. So we're about 12 months away from coming into production. 6 months more of full construction, or 9 months more of full construction, then starting with commissioning and working towards being in production, and the first shipment of product to customers early in 2024.
Great. And now, Minsan's maybe is a new topic to some of our viewers, so I was wondering if you could give us an introduction to what's being mined and where Thunderbird fits into the market.
Yes, I appreciate that for a lot of people, mineral sands is a less common space for them to be sort of investing in. So mineral sands, for the most part, refers to titanium minerals and zircon minerals. Titanium minerals, the primary place they end up is in something called titanium dioxide, and that is a pigment, and it's used to make paint, plastics, paper. It's the opacifier, so it's basically what makes things like paint that you can't see through them. A lot of people associate titanium with titanium metal and the aircraft industry, etc. And while that's a well-known application, it's actually a relatively small part of the titanium mineral space. To say the primary one is titanium dioxide pigments. On the zircon side, zircon is another industrial mineral. It's used three main applications. One is in ceramics, where similar to titanium dioxide, it's used as an opacifier. And you would think about it as what makes, for example, sanitary ware, things like sinks white, and what makes them shiny and white is zircon. And there's also applications, there's some chemical applications, zircon chemicals, and then refractory. So zircon is very good material. Zircon sands are very good material for things like casting, for making investment castings and things like that. So that's another application for zircon.
And I think one of the distinctive things about this project is particularly the very high share of zircon that it has. I was wondering if you could tell us something about the size of the mine and exactly how it fits into the global zircon market.
Yeah, so Thunderbird is actually the world's largest zircon reserve. It's about 50% larger than the next largest current reserve, which is one of Tronox's mines in South Africa. What's also unusual about this deposit is it has relatively high zircon and titanium grade. So it's large and relatively high grade zircon and titanium. It will be one of the larger producers of zircon, even in stage one, and when we do stage two as well, it will probably be third or fourth largest operation in the world at that stage for producing zircon. Zircon, although it's a large zircon producer and it's a large proportion of our revenue, it's a relatively small product by volume compared to the titanium minerals.
And now, certainly from my perspective, looking at it, it seems like the history of Thunderbird really had a turnaround with the tie-up with Yan Steel, which felt like it was a big step in moving towards it. I was wondering if you could tell us something of the history of that and where it's left you now.
Yeah, so the project has been around for a while and had a couple of attempts at financing prior to this. It's a very large, attractive project, but it to start with, the capital was very high. It was difficult to raise the capital, and then it's often with juniors struggling with equity. When Yan Steel actually came along as a potential partner about the same time that I got involved in Sheffield, they're a steel company, a private Chinese steel company, literally owned by three individuals, about 10 million tonnes of steel, very successful company. like a lot of other steel companies in China, they're kind of post-growth now in steel, and they were looking for a new industry to sort of grow into. They saw that their experience in smelting and processing would be useful, and that the Chinese government was favouring particularly the chloride process. So they had made a decision to become a titanium dioxide pigment producer and build their own smelter. And they saw that having access to feedstock was quite strategic for them. So they had gone out and looked around for a potential partner. They identified that Sheffield, as it was at the time, was looking for offtake. We needed an equity partner. And so they made the approach to us in April 2020 with a deal to basically acquire half of the project in exchange for equity, and also offering to take the offtake of the magnetic concentrate product, which contains a very high quality ilmenite. That was their sort of strategic interest. So that's sort of how it initially came about.
Great. And then, so you've, in addition to the finance, you've also recently completed deals for energy and services, and you also, as you say, you have the offtake. So if you could give us an overview of now what the financials of the project are looking like and how you can control costs as you move ahead toward production.
Yeah, so, overall financials, very robust project. We're looking at an NPV for stage 1 and stage 2 combined of just under 1.4 billion Australian dollars and an IRR of about 27%. And to achieve that, the capital investments about 355 million, and we have total funding in place 484 million, which the gap is to deal with contingencies, cost overruns, financing, etc. But from our perspective, there's very limited additional equity is required. So our share of that 50%, we've effectively secured by only having to put $34 million of additional investment in. So for us, the sort of return versus investment from today has been very good return relative to a relatively modest amount of equity. In terms of sort of cost exposure, it's a big thing in recent years. Everyone's familiar with capital cost escalation, particularly in Western Australia. We're fortunate that the capital cost number we had from our bankable feasibility study earlier this year was actually an up-to-date number. It was based on steel and labour costs, etc., from late 2020. So we'd already seen quite a lot of that escalation in our previous estimate, and it was part of the motivation for us actually de-scoping the project a little bit, which has helped us bring the capital down. And then now, as things stand today, of the 355 million of capital we had left or 355 million of capital, as of end of August, which is when we did the last sort of update to the market, we'd already spent we had fixed prices already spent about $298 million of that. So we only have about 57 million left sort of unpriced or unspent. And as things stand, we have 24 million of contingency and 40 million of cost overrun remaining. So we have a pretty good coverage between remaining capital to be spent and sort of the risk money to sit against that. On the operating side, we, like everyone else, will have an exposure to labour cost, although again, the costs have just been updated again, so we're reflecting 2022 costs, not historical. And from the energy perspective, our main energy for power is trucked LNG. It comes from the Northwest Shelf. While one of the consequences of that is we have a relatively high transport cost in our energy, WA is not a bad place to be based at the moment. There is a domestic gas reservation and actually a domestic price cap, and so we haven't seen our cost of our gas under our contract hasn't actually changed this year, despite what's happened in the gas market. So we aren't seeing energy cost inflation the same way that perhaps you would do if you were in other locations.
Mm. And finally, as you look ahead towards reaching production and beyond, what do you see are the other risks that will need to be managed and the other hurdles that might have to be overcome as you ramp up?
I mean, I think the way we'd think about the project now is it is largely de-risked. For a junior, albeit one that has a very strong partner, getting things financed is very, very challenging, particularly mineral sands projects. There's a limited number of people that are actually prepared to loan against them. So we've taken a lot of the risks are out now, having fixed price contracts for our construction, having progressed the project using the Yansteel equity over the last 15 months, where despite only having just made an FID, so we're already 40% complete. So we're left with, I would say we've taken the big risks off the table. We're left with what I would call normal sort of execution type risks. You always have on any project that the risk of time, cost overrun. We are very much running to time on our current, so I don't see that as a particularly big risk, and we are well provided for contingency and cost overrun. We, like anyone else, particularly in WA at the moment, recruiting our operations crew, being able to staff up for the operations phase will be challenging, but we've got plenty of time to do that. I would see those as, that's probably the sort of main risk that we would carry now, is just that ability to actually man up and be ready for operations.
Great. Bruce, thank you very much for taking the time to talk with us today.
Great, thank you.